Good afternoon, everyone. I'm Deborah Feldman, Director of Wealth Management at Fairport Chicago office. We're welcoming clients across all of our offices today, which includes not only Cleveland, but Buffalo Grove, Illinois, which is where I'm at. And we're about 35 miles north of Chicago. Harrisburg, Pennsylvania, Buffalo, New York, Princeton, New Jersey, and Cherry Hill round out the roster. We really enjoy the opportunity to present these town halls as it gives our clients and viewers a chance to connect directly with John Silvas, our Chief Investment Officer. It also gives everyone a chance to meet the leaders from all of the Fairport office locations as we take turns moderating the town halls. Today, John will recap where we've been, his thoughts on where we are today and what might happen in the year ahead. We always welcome your questions in advance, so keep them coming. It gives John and his team time to prepare slides to visually help address his answers. With 6 locations, it's really important that each of our advisors is in continuous contact with the investment team. And here are some ways that you can be too. You can receive Fairport perspectives via email. If you're interested in weekly updates, ask your advisor to share our weekly Fairport market note. You can subscribe to Fairport Flash, a monthly podcast available on Apple Podcasts and Spotify. Finally, you can follow the hashtag Investing with Fairport on LinkedIn and Facebook for frequent thoughts on the markets and economy. Keep in mind that you're muted during this webinar and we're unable to see your faces. If you have questions during the presentation, you can type them into the chat window and we'll answer as many as we can, time permitting. With that, I'm going to turn the mic over to John.
Thanks, Deb. So it's been a couple of months since we've done one of these. We had a pretty good start to the year, so I'm excited about talking about the rest of 2024, and so let's get right into it. So as most of you probably know, this is a presidential election year, and I thought this was kind of funny because it feels like deja vu all over again. I think that was is that a Yogi Berra quote? But so we'll see how it goes. We'll talk about the election a little bit this time, but we'll probably get into it more as we get into the third quarter, I suppose. We'll have plenty of time. Not much new. It's kind of a repeat of last time. So, but I apologize if I look like I'm tired. I was up all night listening to Taylor Swift's new albums. The second of the double albums threw me off a little bit. So I'm a little tired, but I'm going to try to push through this thing as we go. So, but I think, as we get into the first quarter and look into the second quarter and then into the rest of the year, a couple topics we're going to talk a lot about, and we've talked about these over the last year or two anyway. But one is the Federal Reserve and where they're at in their thought process, and as we've seen over the last few days, it's somewhat changed. They've gone from, they're going to most likely lower rates, which I still think they will this year, but more probably in the second half or maybe even in the tail end of the year. Inflation, which we'll talk a lot about, and that's one of the issues I know a lot of clients have concerns about. Some of the geopolitical issues out there. There's a couple different hot spots flaring up. The elections, as I mentioned, and just the economy overall. So unless you got any questions right out of the gate, Deb, I'm going to go ahead and get started.
Actually, John, I'm going to refer to your cartoon because one of our clients poses this question. Does the investment team have a strategy for U.S. equity sectors? And he defines them as defense, healthcare, energy, infrastructure, technology, consumer discretionary, etc., based on the following political events. And these are the 3 options. Behind door number 1, Democratic Party sweep, presidential and Congress. 2, Republican Party sweep. Or 3, divided government where neither party controls both chambers and or the presidency. Do you have an opinion on that or a plan?
Yeah, so we'll talk a little bit about sectors as we go through the presentation. So I'll hold off on that part of it. I think the concern of the elections, which obviously is a big concern, who's going to lead the country for the next 4 years. But from a market standpoint, it doesn't tend to have that much input as you think. Probably divided government is probably, out of those 3 scenarios you gave us, probably the most beneficial. really just because, as we're seeing right now, trying to get budgets passed and aid and all those things, it's very hard to get anything through Congress when one party controls the Senate, one controls the House. So I don't think we would change our sector outlook as much as you would think. We'll talk a little about where we're at today and where our thoughts are in a few minutes. But as far as the election goes, and I don't. If you go back and look at Democrats or Republicans, it really doesn't have that much difference on who controls the White House when it comes to markets. And if I had a choice, I guess I would go with divided government. And in that, I think that's probably the best scenario, just because you really get an opportunity for the checks and balances to kick in, and not one party having say overall. But we'll talk a little bit about the sectors as we get into the presentation.
Hey, John,
Yeah.
can you share your slides?
Oh, I'm sorry.
It's okay.
Let me see here. So how would I go about doing that? Give me 1 second. I'm going to pull it up here. Where's the share button at? Oh,
Very bottom.
yep, I got it. Give me 1 more second here. I am setting it up. All right, a little technical difficulties. I'm getting there. All right, there we go. Can you see it now?
Yep.
All right, sorry about that. I had all these great cartoons and no one saw them. So I'm going to go through them really quick. So that was the cartoon I had on the presidential election. This is my sad attempt at humor when I was talking about Taylor Swift and her new album coming out. And really, probably the biggest economic generation we had last year was Taylor Swift. So maybe this new album or albums can do that going forward. But so anyway, you were talking about the presidential elections. I think we covered that. I'll talk about the sectors in a few minutes here as we get through the presentation. But any other questions before we get started?
No, not right now.
Okay. All right. And you can't see my slides, correct?
Yes.
Okay. All right. Let's start over. Here we go. So as I mentioned, we had a pretty good start to the year. Really, we had a great finish to last year. This is the second time, or the second quarter, I should say, that we had a 10% return. So we were up a little over 10% in the fourth quarter of 23, first quarter of 24, which ended in March 31st, was up also 10%. Year to date, and as you can see, that far right column, the S&P, or the large cap equities, are up about 10.6. I know we've had a little bit of a correction here over the last few days, and we'll talk a little bit about that as well. Small caps are up about a little over 5%. The ACWI, which is a global index of equities that we use as a benchmark, was up a little over 8%, so 8.3%. Bonds continue to struggle, as you can see down towards the bottom of that far right column. Fixed income or bonds were down about 0.8%, or a little less than 1%. I went back and looked at the last 3 years, because I think sometimes it's better to take a bigger sample size. And stocks over the last 3 years, so basically from the end of the first quarter of 21 through the end of the first quarter of 24, stocks were up about 11.4% per year. So that's annualized basis. Bonds were down about 2.5%. So bonds have still continued to struggle in here. We'll talk a little bit about interest rates and where they're going in a few minutes. Volatility kind of remains low. It's definitely picked up here in the last few days, but really, if you look at it through the first quarter, our biggest decline was about 2%. Now, I looked before I got online today, and we were down about 4% from the peak this year, a little over 4% from the peak this year. So almost 5% total as we get into the second quarter, but overall still pretty low. There's actually more volatility in the bonds over the last few quarters than it has been in equities. So something we're keeping an eye on. Historically speaking, election years tend to have a little bit more volatility. So we may see that as we get into the, I know this is likely the longest general election, but as we get into the second half of the year, closer towards Labor Day. I'm probably going to show a lot of these. So, I've been relatively constructive on the equity markets, and I think we had a really big inflection point last October in the fourth quarter of 23. So as you can see here, it's been over a little over 2 years since we saw a new high. So we saw a new high this year in January of 24. The last high in the market was in January of 22. So we had a correction in 22. We had a fairly good market in 23, and then we went to new highs here early in 24. But normally when you have that 1 year or longer between new highs, you can call that a consolidation period. And historically speaking, they tend to be pretty bullish going forward. So as you can see on this chart or this table in front of you, as you look at that yellow area to the lower right, 265 trading days or 252 trading days, sorry, is a 1 year basis. So over a 1 year period, about 93% of the time, with the exclusion of 2007, you see positive or higher markets on average, about 13.4% on the median and about 14% on the average. So I think it's just another reason the markets tend to be bullish in this environment, and I'm probably going to show you more of these as we go through. From a broadening out standpoint, I know a lot of people talked about the Mag 7 last year and how it was a very narrow market, but really we're starting to see the markets, what I would say, broaden out or see more participation. So as you can see here, the S&P 500, after you have 60% of the components, so 300 names out of 500 names, make a 20-day high. So that's more than just 7 or 8 stocks in the market. That tends to be a pretty bullish sign going forward. In fact, the last 15 times it's happened, the markets were higher 1 year later. So again, we're seeing this broadening out of the market. I think we're seeing the expansion of what I think is going to be a bull market probably into year end at least, if not further. So I'll stop there real quick. I don't know if you have any questions from the audience or you have any that we got emailed into us.
In the past, you've indicated that technical indicators are suggesting continued positive returns in the equity markets. What is fundamentally driving the continued strength in the U.S. economy?
Well, I think I have a belief, and I've said this numerous times over the 20 some years I've been at Fairport, is I think as the economy grows, and we're seeing that now, and I'll get into some slides here in a second, that tends to be good for earnings, and I'll talk about earnings, and earnings are growing, and if earnings are growing, it tends to be a good direction where the markets are heading, meaning the markets will likely drift higher as well. So I think that's still the way it works. You have lags along the way depending, but from an economic standpoint, unemployment's low, wages are going up. Some of that's inflation driven, but you've seen higher wages, and demand is picking up. Consumer demand has been very strong. So we're 70% driven by the consumer in the U.S. as far as economic growth, and that seems to be pretty strong right now. I'll show you a few slides as we go through, and I think that's what's driving momentum going forward in the economy. And if the economy is doing well, I think that tends to have a trickle down effect or a positive flow into equity markets as well.
So when you think about what's going on right now in the markets and the economy, what do you think the most impactful topics are that are facing investors?
Well, I would have to say inflation. If you like it or not, that seems to be the headline that we talk about. We're stuck watching every CPI print, every Fed speaker. When will they? I guess to pair it together would be inflation, and then how does inflation impact interest rates going forward, or Fed policy? When will they cut rates, if they cut rates at all this year? So I think if there's one item everybody has their eye on, it would probably be inflation. For us, I think global, or not only domestic or the Fed monetary policy, but global monetary policy is a big deal. We look at a lot of the other inputs like the PMI numbers and things like that on the economy. But I think if there's one thing out there that everybody's kind of laser focused on, it would have to be inflation.
Okay, thank you.
Great. So since we're talking about the economy, I'm going to jump right in here. So we finished last year, 2023, on a pretty strong note. I said we were trending towards trend, which is, again, my attempt at humor. But if you look at that blue line there, that's the long-term trend of the economy, or GDP growth. So we grow about 2% annualized, and this goes back to call it 25 years. And if you can see that red box there, last year we grew about 3.1%. That's the lower number, the year-over-year number. The fourth quarter number was a 3.4. That's seasonally adjusted on annualized rate. That's what the SAAR means. But really, we grew about 3% last year. So that's above trend. As you can see, that gray line, which is the actual economy or GDP growth, we're right about trend right now. So where we head going forward is kind of what I meant by trending towards trend. So far this quarter, and we're so far for the first quarter, which we just completed, the economic data looks pretty good. Kind of continuing off that fourth quarter that I just mentioned. GDP now, which is another indicator we use quite a bit from the Atlanta Fed, and it's been one of the most accurate out there, is estimating about 2.9. There's a few more data points, and they're going to come out. I think it's next week. They're going to come out with the GDP number, at least the first read, and they'll revise as we go forward. It's probably going to come in somewhere between 2 and 3%, my guess, and probably on the higher end of that range. Right now, it's trending about 2.9. That can change a little bit between now and next week, but again, I think overall the path of the economy is we're still on that soft landing path, which is not. Which would indicate that we probably avoid a recession going forward. In fact, most economists out there have been lowering their probabilities of a recession. As you can see here, probabilities, and this is going back to March, so this is a little stale, it's probably even lower than that, is right around 30%. And my guess is if we saw that today, it'd probably be closer to 25%. So more and more economists out there are starting to realize that like they were wrong last year predicting a recession, the likelihood of a recession here in 24 isn't eliminated, but it's starting to wane, and I think it's waning fairly fast here. So just to give you an estimate or some examples, JP Morgan raised their guidance for the year, especially in the first quarter, but also for the year. Goldman Sachs did as well. Evercore ISI just recently came out and raised their estimates for both the second and third quarter higher, not lower. So we're starting to see a lot of those people, a lot of those economists on the street revise their estimates up. Excuse me. So, overall, I still think inflation is cooling. That's probably not a popular belief at this point, since we had a couple numbers that came in a little higher than expected. But I think overall, coming off that 9% that we saw a little over a year ago to last year, where we saw the numbers cooling, and we're right around that. And I'll show a chart earlier or later here on inflation. We're right around that 3.5% range, give or take. But I think one thing that is potentially an issue here is we're starting to see commodity prices rise. Most of those are metal commodities like copper and a couple other what we call industrial metals. But you're also seeing things like cocoa rise, and I'm not really sure why cocoa rose, but it's up about 100%. So if you buy Hershey Kisses or Hershey bars, my guess is you're going to start to see either they make the bar smaller, or they're going to raise the prices. So there are some signs out there that inflation may not be only heading in one direction. So again, as far as the economy goes, there's a lot of different inputs to that. One of the ones we use, which you think is a pretty good coincident indicator, is the Evercore company surveys. And I've showed this a couple times. And if there was only 2 or 3 different data points that we would look at to kind of get a good read on where things are or where they're going to be heading in the near future, one of them would be using this company survey. And historically speaking, it's been a very good indicator when it gets around that 45 number. Right now we're around 50. It got down to about 47 not that long ago, but still holding in that range where they would say the economic forecast is still pretty solid. But definitely it's slowed or come down off of that high, which was like around 60 back in the end of 22. So again, that's one of the ones that comes out weekly. We keep a pretty close eye on it, and still not flashing a red light yet, a red sign. And then finally, the job market is holding steady. We're still under 4% on unemployment. We're at 3.8. It's actually ticked down. So, as we look out on the economy, and I jotted a few things down. We look at the GDP now number, that still looks pretty good. Look at the company surveys, which I just mentioned, they still look pretty good. The unemployment rate is still under 4%. That's a positive. Unemployment claims, which come out weekly, are still very low historically speaking. The last one came out was 212,000 on a weekly basis, which from a historical standpoint is very low. Retail sales, which is another great sign of the consumer, was higher than expected last month. So again, another indication that people are out spending. And then, excuse me, as I mentioned, or will mention here soon, credit spreads are still very tight, which is a good indication that the economy is on pretty firm ground. So any one of those numbers could change, and those are things that we kind of keep an eye on. But right now, that kind of tells us that the economy is still on what I would say firm footing. So I'll pause there because I need to get a drink of water. But any questions?
You mentioned your opinion about the possibility of a recession. What about a financial market correction?
So I'm going to talk about that in a second here. But I think we're probably in one. Corrections and consolidations happen all the time. And I got a chart later on in the presentation that kind of shows you the numbers to that. But I think you're going to have corrections or consolidations, however you want to define those, in bull markets. You're going to have them you can have them over time, which means it could take, market could just move sideways for 6 months, or you could have a correction where the market goes down 5%, which I think is kind of where we're at today, or what we're seeing. And then there's a reversion back to an uptrend. And those happen all the time. Markets tend to move, and we'll talk about valuations here in a second. So in the current environment, I'm not too concerned by it. You have to be able to plug your nose in some of these things and buy when things look bad. And I think this would be one of those opportunities. You have a bad week in the market, you're probably better off to buy going in the next week than you are to be selling. So that's kind of our thought going forward. But I have a couple of slides, so unless you have another question, these will kind of roll right into what we're talking about.
No, thank you.
We do have one in the chat, John, if I can read it for you.
Yeah, go ahead.
Sure. There is constant talk about inflation. It's up, down, target goals are rarely reached. Why isn't an inflation number more predictable and more exact?
Why is it inflation number isn't more predictable or more?
Correct.
Oh, well, there's a lot of economic data points out there, and there's a lot of different ways to slice and dice inflation or price increases. We use the consumer price index, which is the CPI number. I think the Bureau of Labor Statistics comes out with that one. You have the PCE, which is the price consumption expenditure, which is what the Fed tends to look at more. And there's other ones out there. None of them are perfect, to be honest with you. And they all tend to look in the rearview mirror. So that's always another issue. Why aren't they more accurate? Well, I guess it depends on how you define accurate or what you think is inflation. Because I think, I've heard people say, well, when inflation posts a 2%, they'll go, yeah, but there's inflation other places, and you can always point something else out. And so that's a tough one. They are produced by government agencies, so that's probably another reason why they're not super accurate. But I think they're about as good as you're going to get, and I think you're always going to be chasing those numbers and trying to find a better mousetrap. And I'm just not sure there's one out there. CPI is more or less universally accepted as the reading on inflation, and markets react to that, as do the public. So The Fed uses PC, and I think if you stop somebody on the street and ask them what PC is, I would think 9 out of 10 people wouldn't know. But that tends to be what the Fed focuses. In fact, they focus on the core PC, which is stripping out energy and food. So there's a bunch of different ways to slice it, but yeah, it's not a perfect number. I don't know if there is one. I'm sure anybody that comes up with a different version of it will always have some criticism to it. So probably don't lose too much sleep over it. All right, so I'm gonna go ahead and move on. So we're talking a little bit about markets and what moves them, and I think Deb, you mentioned about technical indicators and some momentum and things like that. So again, I've said I'll probably use a lot of these slides. I tend to focus a good bit on these, not so much on a guarantee of where we're going. That's not really the case. It's just more historically speaking, when we've been in these environments before, what happens going forward. Here's another great example. In the stocks were positive and bonds were negative in the beginning of the year, of the beginning of 2024, which is basically the first quarter. Historically speaking, when you kind of get in that range, the average for the rest of the year, when you have stocks are positive and bonds are negative in the first quarter, stocks tend to continue to be positive. Now, I won't predict 10% for the next three quarters, but you do tend to see a positive trend there, and then you do start to see some positive trend in bonds as well. So again, it's a positive backdrop going forward. You mentioned about consolidations or pullbacks. I think we're probably in the middle of one. We were down 4.7% from the high as of this morning, so that could change. Maybe we get to that 5% number. And I think you're likely to see these consolidations. We're kind of at the beginning of what is considered a seasonally weak period. Once you get through tax day, which is April 15th, things tend to get a little weaker. That could continue throughout the spring, maybe as we get closer to Memorial Day, or maybe even the 4th of July. So it's not uncommon to see it here. We had a 20+% rally off the October low of last year. So sometimes you have consolidations in the market. Again, in an uptrend, that's not uncommon, and I think we can see that. The bigger picture, we have seen the beginnings of being somewhat oversold. 20-day lows are at 55%, and that tends to be a pretty good entry point. So again, I'd be more willing to buy the dips on this opportunity than I would to be selling into the weakness. But again, I think we're kind of here. We could chop around over the next few weeks or months, but I think as we kind of consolidate or digest some of the movement we had in the last 2 quarters, I think the uptrend will remain intact. No doubt valuations are stretched, though. We're trading currently about 20 times earnings. We finished the quarter basically 2 weeks ago at almost 21 times forward earnings. So over the next 12 months, what earnings will be for the S&P. I think one of the themes we mentioned at the beginning of the year, and I think will hold true this year, is most of the returns we're going to get in the markets this year, I think, will be driven by earnings, not expansion in multiples. We have seen some expansion here in the first quarter. Even if we stay around 20 times or even maybe slightly below 20 times, I think most of the gains going forward will be on earnings, not on multiple expansion. So just to kind of follow along that theme, as you look, the dotted red line, we finished last year at $220 on the S&P 500 as far as consolidated earnings this year. Markets and that line tends to be, that blue line in the middle tends to be the trend of where it's going. So it's earnings tend to trend a little bit lower as the year goes on, but right now we're expected to finish somewhere around 245, give or take. That could drift a little higher, and if I had to guess which way it would go, I think it's going to be a little higher than that. But again, somewhere around 243, 245, and then so far next year, which we're still pretty early on, is around 276. So if we continue to grow in that progression that we're seeing there, I think that'll be positive for markets. And again, just to kind of give you an idea, we're only a little over 10% through the first quarter earnings. So we've had a couple bigger ones, JP Morgan and a couple other ones have already reported this last 2 weeks for the first quarter, and so far earnings are growing about 7%. So I don't know if that trend will hold the whole quarter. Again, we're only a little over 10% through, but it's something, you know, we're keeping a close eye on, and we do expect earnings growth throughout the year. So one more chart on returns going forward. I probably have one more in here somewhere, but first 50 days of the year, you know, we were up 8.3%. That tends to be bullish. 96% of the time, you'll finish the rest of the year up about 12%. So, you know, give or take the last almost 3/4 of the year, you'll see returns be positive. That's 24 out of 25 times going back to 1950. The only exception being 1987, and obviously we had a fairly large correction in the market in the second half of the year in 1987, which I don't really want to talk about. But anyway, again, I think if there's one thing most people will be focused on this year, it's going to be interest rates, the Fed, and inflation, and secondarily politics, both geopolitical and here in the U.S. elections. But right now, we're seeing the 10-year Treasury kind of make a move higher. We were I think the highest we saw this year was 4.7. We were at 5% last year. I still continue to think we won't see 5% in 2024. I know only in the fourth month of the year, so there's a lot can happen here. But I think so far, you know, one of the themes we had at the beginning of the year is we thought the high last year would hold at 5%. We also thought the Fed would start to cut rates sometime in the beginning or middle of the year, and that's looking less and less likely. But that being said, you know, rates are moved up to about 4.7%. They're slightly overbought here, as you can see in that red dotted circle down below. We think we could see a little further increase, but we don't expect them to get to 5%. You know, I think at the end of the year, we're going to see rates lower than they are today. And that's assuming the Fed cuts rates sometime in the second half of this year. Again, I mentioned earlier, we're keeping a close eye on spreads, and as you can see here, they're about as low as they have been over the last 15 to 20 years. And you know, we're watching for a breakout in spreads. If the spreads start to break higher, that means people on the lower end, people have either companies or individuals that have a little less credit worthiness start to pay higher rates, and that tends to happen. Those spreads tend to widen between junk and investment grade. That tends to be an indication that the economy's starting to come under some stress. And as you can see here, that's not the case so far. But when you do see those moves, and we saw it back in 2008, that red circle, you know, that can be an indication that, you know, if they move very quickly, that maybe we're moving into a recession. But again, so far they look very good. So real quick, I'll go through the rest. We talked about inflation about as much as I want already. So all eyes are on inflation going forward. We still think we'll get below 3% by year end. That's probably looking a little more difficult than it did a couple months ago. But as you can see in that darker blue line, inflation, and we talked a little bit about how they come about these that have all items in it, it's about 3.5. If you strip out food and energy, it's about 3.8. Again, I don't think we're going to see inflation drop or decrease the amount of growth over the year in a straight line where it's down X% every month, and it just looks like it's chugging along. There's going to be fits and starts. There's going to be pullbacks and move forward. So again, I think we're in one of those periods where we're digesting some data, but I think longer term that the trend is still lower. And you know, if there's any good news to the Fed not being in a hurry to cut rates, that tends to be good for markets. If you're in a slow cycle, which is that higher blue line there, versus a fast cycle or even not cutting rates. Markets tend to look pretty good. So that first dotted line on the left there is when they cut rates first in a slow cycle. And I think from everything we've seen so far, we're going to be in a slow cycle here. They're not in a big hurry to cut rates or cut rates at an aggressive pace. So that tends to be the best outcome you can have. So that's kind of where we're trending right now. Chairman Powell's statements earlier this week tend to think that we're going to be, as he likes to say, higher for longer. And I think that's kind of where we're at. But I do think we will see rate cuts sometime in 2024. It might only be 2 or 3 versus the 4 or 5 that most were predicting earlier. Any other questions, Deb?
Well, as long as you were talking about earnings, do you feel earnings can still grow and equity markets have positive return if interest rates remain at the current prices?
So just to differentiate between the rates, so the Fed fund rates, the Fed cuts rates, that's going to be most impactful on the short end of the curve, which means the money market rates and e-bill rates, which are less than 1 year. The 10-year, which I mentioned earlier, is around 4.65 maybe. The 10-year tends to be the one that drives lending and mortgages to a lesser extent and things like that. So it would be beneficial for that rate to come down. We were at 5%, and I think we got down to a little closer to 4. We got back up to 4.7. So we're it's trying to find its footing here somewhere, but I don't know. So I don't think the Fed has to. Ideally, if they cut rates, that'd be the best for the markets. If they don't cut rates, I don't think it would be the end of the market advance. I do think if they started talking about raising rates, which I think we're very far away from, and that's a long way down the road, then I think that would be a detriment to equity markets moving forward. As far as the 10-year goes, I think if it continues to rise to 5% or above, I think that would be problematic for the markets. I think a 10-year above 5%, and I'll throw oil in there. You didn't really ask about it, but if oil got above 100 and it was above 100 for geopolitical reasons, I think those would be negatives. But so far we're not that close to those things. So not too concerned yet, but I'm definitely hoping for lower rates and oil prices to stay where they're at. I was at a conference last week in New York at JP Morgan, and Robert Gates, who was the CIA director and director of Secretary of Defense under several presidents. I think he said he served 6 different presidents from both parties. He made a statement which I thought was really interesting. He said if a war lasts longer than 1 year, it tends to go 10 years. So he was talking about the Ukraine in that instance, but he mentioned Afghanistan and Iraq, and he said once you get past the 1 year mark, if it hasn't been solved by then, you tend to dig in, and these things can last longer. So I don't know what the actions in the Middle East have long term, but if this thing tends to drag out for a longer period of time, that would probably be a negative. So just a data point to think about.
As long as you shifted over to foreign affairs, what's the investment team's outlook for non-U.S. equities, developed and emerging markets in light of global unrest versus the U.S. equity markets?
So I'll get to that in a second. So I have a slide on that.
Okay.
So, but I will definitely address that, and if I don't, we'll circle back. But
Okay, so then we have another a question on international investing. How does the U.S. monetary policy impact international investments?
Well, so the U.S. monetary policy led by the Federal Reserve is really, a couple. One, they are expected to lower rates. I think they're in the beginning of an easing cycle. They haven't eased rates yet. They have definitely not. They have stopped raising rates. So we're kind of in that transition period
Mhm.
with the assumption that we're leaning towards lower rates. So, lower rates tend to lower borrowing costs, tend to lower financing costs. So I think globally speaking, that's a positive. But the U.S. may not be the first to cut rates. I know the European Union, the European Central Bank, the ECB, has indicated they're going to cut rates most likely at their next meeting, which I think is in May. So there's a lot of moving parts within monetary policy, not just the U.S. but globally. But I think big picture, an easier monetary policy or the Fed in an easing cycle tends to be good for global growth. We tend to be the engine that drives things. So, and if we get coordination with the European Central Bank and other central banks out there, I think that's a positive going forward. So that should be beneficial. But yeah, I think we tend to be the straw that stirs the drink, I guess is the term or the saying. So let me jump into these and then I'll circle back. If I don't answer the question, let me know.
Okay.
All right. Yep, no problem. So one of the questions you asked right out of the gate was about defensives versus cyclicals, value versus growth, and a couple other things. I didn't write them all down, but we tend to look at things more from a cyclical versus defensive, and I would define cyclicals as consumer staples. I'm sorry, consumer discretionary, industrials, technology, and to a lesser extent materials. So as you can kind of see here, we're overweight consumer discretionary, we're overweight industrials, we're overweight tech. That's a little misleading. We're probably a little more overweight tech than it says there. And defensives tend to be staples, real estate, utilities. So as you can see in the bottom part there, we're underweight utilities. That's our biggest underweight. We're slightly underweight real estate. We are overweight staples. That's a little misleading as well. We have a very large position in Costco, which tends to be one of the staples, and it's done very well. So as that grows, that tends to be a bigger position. And we're not going to sell a company that's growing well and has great earnings just because we want to move out of the sector. So that's a little misleading. But again, overall, that would be an area that we probably wouldn't be adding to going forward. So from our stance, we definitely have a cyclical bias. That tends to be a growth bias as well, and we're underweight defensives and value. So in our model that we use, value and growth ETFs, we're slightly overweight growth. We're about 54% growth and 46% value. So just kind of to give you an idea, it's not a large overweight, but again, we're leaning towards the growth direction. I know the question originally was asked about the presidential cycle and who was in charge, and I don't think we would change these positions solely on the outcome of the election. It's probably more on the outcome of the economy, where we're at currently and where we would be then, and or where we're at in earnings growth and a couple other things I mentioned before. So it would be one of many things we would probably look at, but it wouldn't be something I think that would drive a change just in and of itself going forward. So I think that answers the question we had earlier.
It does. Thank you.
Great. So again, the cyclicals versus defensive. This chart's a little bit older. I used it a little over a month ago, but again, it shows the picture where that top chart is the S&P 500. At the bottom is cyclical names, which are the sectors I mentioned relative to the defensive sectors I mentioned. And as you can see, we're seeing on a relative basis, seeing a breakout, and we think that's going to continue into the second half of the year. We might be one of those periods where there's some give back along that way, and a lot of that's driven by tech and consumer discretionary, of which, as you can see, there's a little bit of consolidation here and a little bit down here. But overall speaking, consumer discretionary names have been performing better than the stable names. And I think that's going to continue throughout the year. We'll have, again, some of these periods where it consolidates and we'll see some pullback along the way. But I think overall, the trend will remain intact as we go through the year. Real estate, that's a tougher area. We're not largely underweight real estate, but we are by a few basis points. As you can see here on that bottom part of the chart, relative to the S&P, real estate's been underperforming. Again, I was at a conference last week, and Jamie Dimon, who's the CEO and I believe chairman of JP Morgan, was speaking, and they have a pretty vast real estate holdings. Most of them are probably in the commercial real estate, more of the office buildings and those type of things. But his point was he thinks the final flush out in real estate probably doesn't happen until 2025. So his indication would be there's a little bit more to go here. And from our standpoint, we've been underweight the sector for a while, and I don't think we're going to change that direction anytime soon. So small caps, it's been a frustrating position. As you can see down in this lower right-hand corner, we had a big move up in late 23 into early 24. And then we have more or less given most of that back up, and we're right back to that support line, which, as you can see in that red dotted line, I think the catalyst for small caps will be lower interest rates. The Fed's starting to cut rates. That tends to be a good catalyst for them. And again, smaller companies tend to rely more on funding, and the interest rates come down, the cost of capital goes down. So I think as we've seen the Fed push out rate cuts further into this year, we've seen small caps kind of roll over relative to the large cap space. So something we're keeping a close eye on. We haven't added to them this year, but I think it's something, we still think as we look out over the year, we still think, they're attractive. And I'm sticking with the thought that I think as we see rate cuts here, we're going to see a rally in small caps, and we'll, on a relative basis, probably at least keep up with large caps this year, if not do better, but not out of the gate very well on that one. So we're keeping a close eye on it. And then the international, it just continues to struggle versus domestic equities. We talked a little bit about monetary policy as it relates overall. And I think if we see rate cuts overseas and more aggressive rate cuts in Europe and elsewhere, that's going to be a positive for international equities. I don't know if that gets enough to be a catalyst for change, but that would definitely be one of those things. I think Japan, broke out to a new high. I think it took 15 years or 40 years. It was a long period of time. They finally broke out. They're back to where they were. They have shifted. They're starting to see in their case, they're starting to see a little bit of inflation, which they've been trying to get. So I like that area. That's one area that that we think Asia Pacific looks somewhat attractive. And then from emerging markets, we're adding to. Let me rephrase it. We're adding to a holding that will decrease our Chinese exposure and add to India. I think India tends to be the better area there. But to answer the question, what's the catalyst to make this move? It has been somewhat elusive, and again, we believe in diversification. If you took this chart out, more than 10 years ago, 20 years, it shows a much better picture. But the reality is, over the last 10 years, it's been a struggle. I think the dollar's kind of on the precipice of maybe breaking out, which will, if that's the case, will be a headwind towards international equities. But we've definitely increased our domestic exposure over our international exposure. We very well may do that again this year. So I wouldn't say we've thrown in the towel, but we definitely are looking for that catalyst, and so far it's been elusive. But I think the areas we're looking at would be a weakening dollar, which has been consolidating for the last year and a half, and a coordinated global monetary easing, which so far looks like it's going to happen, but there's a lot more before that actually does. No one's actually really started to cut rates aggressively yet, but it looks like Europe's going to lead the way on that one. So that's what we got for the markets and the portfolios we have. got a couple of thoughts about what's going to happen going forward. I don't know if we've covered everybody's questions, but
There is one more, John, that quite a few people have asked, and it's
okay.
since inflation is greater than 3% and it seems to be sticky and having a difficult time getting to the Federal Reserve's target of 2%. Does the investment team have a strategy for the fixed income side of the portfolio, long-term, intermediate term, or short-term predominantly, or an even mixture of them?
Yeah, so the word sticky has been popping up a lot lately,
Yeah.
as it relates to the economy. So let me kind of circle back. I think the 2% inflation target that the Federal Reserve has mentioned, and it's kind of one of their dual mandates with along with unemployment being low. I think they're going to get close to it. I don't know if they have to get right on 2% before they cut. So I don't know if they'll ring a victory bell at 2.9, but I think we're going to get somewhere below 3%. And we may not get to the 2, but I think that's the goal, to get closer to that number. As far as how we positioned ourselves, so if anybody really wants to dive deeper on this, feel free to reach out to your advisor, and my colleague Rick D'Amico can either jump on a Zoom call or a phone call, however you want to do that, or you can come into the office if you want and talk a little bit more about the strategy. But we have been pretty defensive as far as fixed income goes, meaning we kept what they refer to as duration a little shorter than the benchmark that we use, which is the Bloomberg Ag, and that has helped us relative to the benchmark as rates rise. So we've been a little short duration. So as we've been putting money to work for clients, we've been on the short end of that, but we have been putting money in the 1 to 2 year treasuries. We were doing, because at 5% on 5% plus on 3 month or 6 month, it's pretty attractive. I think we are shifting a little bit and kind of lengthening that out towards 2 years for people, just because we think the Fed will raise rates at some point. You're better off to lock it in, even if you give up 25 basis points in the short run. I think over the next 18 to 24 months, it's beneficial. So we've been short duration. There will be a point in time here, if the Fed does start to cut rates, you want to start to lengthen out duration. We haven't been real aggressive on that. I know some investment managers have been a little more aggressive getting out towards duration because they want to be able to capture the point where the Fed starts to cut rates and rates come down. We're kind of in a show me view on that. So we've been waiting, but again, I think we will probably lengthen out duration a little bit later in the year. But as far as the shorter term money, and especially for clients that just want to kind of keep it on the short end of the curve and invest in something safe, we've been using the 3 and 6 month paper for a while. We've been stretching that out to a little bit over a year now. So that's probably our biggest change recently. But we're not, as you know, Deb, we're not really looking to make excess gains on our fixed income. We're trying to keep it somewhat more of a defensive position. So we may be, as I like to say, a little late to the party as far as lengthening out duration, but I think we still have some time ahead of us on that.
Okay, thank you.
Yep, no problem. So what to expect? I talked about a few things. We have geopolitical issues everywhere. That's starting to flare up. I know there was a issue overnight, and I think if you guys watched the futures, they were down 1.5%, and they kind of recovered this morning. They've been back and forth, but we'll talk more about it. But the presidential election always tends to hang over these things, and it feels like we talk about the presidential election every year. But I know it's a 4-year cycle. But one of the things I find interesting, and it kind of goes back to our talk about inflation and unemployment and those things, is something called the misery index. So you take inflation and unemployment and you add it together. Well, believe it or not, people record these things, and if you go back in history, so there's a line or an arrow pointing up there. The last 3 month rolling average, we were at 7.05. Well, if the misery index, meaning inflation and unemployment, is at or below 7.35, the incumbent tends to win. We got a long way to go. We got several more readings to happen, but we're kind of as it looks today, that's a big benefit for President Biden, but we'll see. And I think the biggest issue is inflation stays sticky here, as you use the term sticky, then I think it's going to be a little tougher for him. If inflation does start to roll over, I think he's probably in a better spot. But that's something you want to keep an eye on. It's pretty easy to do. You just take the two numbers and add them together. So it's something we've watched. But that being said, the S&P 500 tends to increase. During presidential re-election years. So if the we're in the S&P total return, as you can see in these blue bars here, in election years with the incumbent running for re-election, really, if you go back to 1940, since then, every time the incumbents run for re-election, the market is up. So we'll see how it plays out here. But it's not something I would probably bet the house on. But these things tend to play out better than you think. So we talked about corrections. We talked about the market. I tend to think we're in a bull market, and this will last throughout the year, barring any type of recession. But you got to expect corrections along the way, and these things happen all the time. I use this term a lot, but as you can see in that middle chart, the orange, 5% corrections per year, they happen about 3 times a year. The light blue on the bottom, 10% corrections, they average about 1 time a year. So to think you'll get through the year, I know I showed the chart at the beginning about volatility, but getting a 5% correction is pretty common. We're probably in the middle of one of those right now. Sometimes those 5 turn into 10% corrections. That's a different issue. But again, I think, as far as I'm concerned, I think those are opportunities to readjust portfolios during those timeframes, and that's our stance as we move forward. So, and this will be the last one of these, but I do love these charts or these tables. We had a positive November, December, January, February, and March. So we had 5 months straight where the markets, all 5 months, the markets were positive. Historically speaking, if you look at that box, I won't bore you on all the data, but if you look at the box in the red box in the lower right, 9 months later, meaning the last 9 months of the year, after March, markets tend to be up 100% of the time. I think there's 12 instances there. And then if you look at 1 year later, it's up 91% of the time. So basically 11 out of 12 times. So, again, that's kind of one of those things I would say is kind of the wind at our back. And we do get a lot of questions from clients when I sit in client meetings about, other than stocks and bonds, what else can we invest in? What else is out there? And you're always looking for what we would call non-correlating assets that don't tend to move up and down with stocks and bonds in a high frequency. So one of the things we've been talking to clients about, and again, I would suggest you reach out to your advisor if you're interested in having this conversation, is infrastructure. And there's a lot of, there's a big infrastructure bill not that long ago passed by President Biden. It's probably the only bipartisan thing that got passed in the last 4 years. We're talking about building out the power grid for all the AI and all that stuff, and all the electric vehicles. So that's another issue with infrastructure, and then data centers. And I don't know how many bridges have fallen down recently, unfortunately, over the last couple years. So this is one area we think looks attractive from a non-stock and bond view. And again, if you have any interest in it or want to hear more about it, we're happy to do that. But I reach out to your advisor. So with that, I'll ask if there's any more questions, Deb. I have to go through the disclosures or I'll get in trouble. So here's one and here's the other one. But any other questions that we either got through the clients before or have come in since?
John, I want to be respectful of everyone's time. We're at the 12 o'clock mark.
Okay. All right.
So, If we were unable to get to your questions today, the investment team or your advisor will reach out to you directly. And last but not least in our presentation, we want to thank you for joining us today. It's our privilege to inspire you and your family, and we feel sincere gratitude for your trust and loyalty. Looking forward to seeing you all next quarter. Have a wonderful afternoon.
Thanks, everybody. Thank you.